right this very second could be the best time to refinance in 2025. And the unfortunate truth as a mortgage broker is I know that some people are going to let this opportunity pass them by. I've seen it happen time and time again in my business over the last decade. Everybody is talking about lower interest rates. They're talking about the fact that rates are going to go lower, but here's the truth. There's no guarantee they'll go lower. In fact, by waiting, you risk the opportunity that's in front of your face to improve your payment, to free up cash flow, restructure debt, whatever you're doing the refinance numbers for. If the numbers make sense and refinancing saves you money now, that's the opportunity. Don't wait for the perfect rate. Don't wait for an eighth better or a quarter better. Take advantage of what's in front of you. I'll tell you at the end of the video why this whole marketing thing around the Fed cutting the Fed funds rate is a bunch of smoke and mirrors. That is not going to have the impact on mortgage rates you think it will. So let me jump into a real life scenario just so you can see it. I think people learn a lot better and they understand it a lot better when I just show them a real life scenario. These are the conversations I'm having. This is a scenario where I'm begging and pleading, and maybe I don't try that hard, but I'm telling people, listen, this is an opportunity where if I was in your shoes, I would press play. I would lock this refinance in place and I would move forward because one, there's no guarantees it gets better. And two, there's a high likelihood it's even happened to me in the last couple of weeks where an opportunity has come up. People have been like, I don't know. A week or two later, when they come back, you know what? Rates are up a quarter. I don't know if it makes sense still, right? And so let me show you this example so we can talk through some real numbers, something that you might be considering. And this is just a rate and term refinance. In my opinion, this is really straightforward. You've got a current payment of $41.85. I don't remember the exact rate on this person's mortgage, but I believe it was 7.25. And we're going down to 6.25 interest rate, and we're saving them $430 a month. Sometimes we have the taxes and insurance built in here. Some people pay that separate. And in this case, it's easier to see the refinance break even without any of that stuff built in. But I show all the numbers. They know what the costs are involved with this, even if it does wrap into the loan for the most part. You know, the costs are factored into, I'm saving $430, I'm baking in, I believe in this case, it's, $7,000 or so in costs, but I'm breaking even in 19 months. Now, everybody's got an opinion on this. I know that if it's a 12 to 18 month break even, it's a green light. You refinance it unless you plan on moving. If it's 18 to 36 months, you might want to consider it. This one's right at 19 months. And so it makes all the sense in the world. You don't know if rates are going to get into the fives. You don't know that you'll be refinancing into a 5.99. And like I showed in many videos, and I can walk you through the numbers here, even if rates, which go up, down, even if they get to 5.99, you know what happens when you stay in this loan for another 10 months? And by the way, 10 months flies by. Rates pop up a little bit, something gets said at the Fed meeting, other economic news happens, and all of a sudden we're in an environment where rates go from mid sixes to 6.7, or they just float in the mid sixes, right? You never get down to the 5.99. All of a sudden, you've got this mortgage for another 10 months, this $430 in monthly savings that you could have if you refinance today gets paid in interest that you shouldn't be paying to the same person you're paying $41.85 a month to for 10 months. Now you've got $4,300 in extra payments, and rates finally get to 5.99. But by this time, it's well into 2026. And let me show you, $37.55. We get to 5.99, $36.52, $430. Yes, you save an extra $100 a month. You're going to wait another 43 months to break even because you've paid, sure, you're saving an extra $100 a month, but you've paid an extra $4,300 in the 10 months leading up to that. And so that is why a lot of times when these opportunities arise, people need to get out of their own way. And they need to just understand that I'd love for it to be 5.99. I'd love for it to be 5.75. I'd love for it to go to 5.5. But it's come down from the low sevens where I bought to the low sixes. And on $600,000, you're saving a full percent in interest. You're saving $430 a month. Just go, right? And this isn't a sales pitch. This is real life scenarios. Me being in the seat where, unfortunately, I'm the same one having the conversation 2 months from now. Let's take a look. Nah, it's worse than when we looked at it last time. 6 months from now. Sometimes people come around, they're like, just give me 6.375 or 6.5 because they miss the opportunities in front of them and they take a worse opportunity, or even worse yet, they just stay in this loan 430 and 430 and 430 and paying that extra interest month after month after month. Now, I've got something I want to read to you because this is from a little research I did about Fed funds rate. We all know that the Fed is going to cut the Fed funds rate in September of 2025. And depending on when you're watching this video, it might be that you're watching this video later and you've got future Fed cuts coming up in the future. Don't let anyone use that as marketing to tell you that mortgage rates are going to go lower. What I'm going to show you, and I'm pulling it up here, apologize while I'm trying to talk and pull something up. This is all on the fly, but I'm going to pull up a really, in my opinion, well-written, simple and easy to understand why the Fed funds rate doesn't always mean that mortgage rates are going down. So bear with me as I pull this up. All right, let's look at it like this. A Fed rate cut doesn't always mean lower interest rates. A lot of people think that the Fed is cutting the Fed funds rate. Mortgage rates are going down. It's not how it works. And I'll give you a quick example. September of 2024. That was only a year ago. It's not that long ago to recall that the Fed dropped the Fed funds rate, not by 25 basis points, but by 50. And you want to know what happened with rates? Look at this right here. This was September of 2024. We had the rates in the low sixes. The Fed cut the Fed funds rate by 50 basis points. Look what happened in October. Rates went up 0.5% to 6.625. That is after a 50 basis point Fed rate cut. So don't tell me that the Fed cutting the Fed funds rate is going to lower mortgage interest rates and you're going to wait for a Fed cut so that rates go lower. It is not how it works, right? It's the Fed funds rate is the rate at which the money is borrowed overnight. It's the shortest of short-term rates. 30-year fixed rate mortgage is the longest of long-term rates, right? So Fed funds rate is the overnight rate that banks charge each other. Mortgage rates are long-term rates, and they're tied to the bond market. The bond market affects this, right? The 10-year treasury yield, which right now I think it's in the 420s. When you're watching this, we'll see where it's at. So investors buy and sell mortgage-backed securities based on optimism, based on the bond market, and that's either going to drive mortgage rates up or down. When there's a lot of certainty, rates can be lower, and when there's uncertainty, that 10-year yield's got to be higher, and that generally pushes the 30-year fixed rate higher. Mortgage rates move based on inflation, expectations, investor demand, not directly on the Fed's short-term moves, and sometimes the opposite happens. That's like I talked about. That was last September. If the Fed cuts rates because the economy is weakening, or like they're doing probably the end of 25, that we've got a labor market that's just not as strong as they expected, bond investors might demand a higher return, and that can push mortgage rates higher, even when the Fed is cutting, right? That's what happened last year. You don't have to look back that far. Historically, there are many examples where the Fed cut rates and mortgage rates stayed flat or even increased. Just last year that happened. Again, over time, that Fed funds rate and 30-year fixed rates will kind of rhyme, but in the shorter term, like, you can't rely on that, right? So here's some analogies for, the Fed is setting the gas pedal for the overall economy. It's just a long story short, you can't rely on the Fed funds rate going down, lowering mortgage interest rates. If you have an opportunity in refinance, I plead, whether we're working together or you're working with somebody else, take the opportunity. Make sure that you've done the kind of break-even analysis that I do with clients. Make sure that it makes sense. Don't just do it for the sake of doing it. But if it makes sense and you see the numbers and it's going to benefit you and get a better, monthly cash flow situation for you and your family, don't wait. Don't wait for some magic moment in the future where rates are a perfect number. That's a recipe for disaster. If me and my team can help in any way, go to greatmortgagebroker.com. I'm more than happy to help. Talk to you soon. Bye-bye.